Hi there, Brock VandenBerg with Talamar Financial and Fund Manager of Talamar Income Fund. Here we invest on behalf of high net worth investors in the private real estate debt market. Also like to educate investors about how to safely invest in this industry. I invest on behalf of, well, right now about 155 different investors, including myself, in our mortgage REIT. If you're interested in learning more about the mortgage REIT, I put a quick description down there and a link to our website where you can learn about what type of loans we fund, how you can invest in it, what kind of returns you can earn. So today, I've been going over the top 5 things that I look for when I fund a hard money loan. And today we're going to focus on loan to value ratio and why loan to value is an important metric you should use if you're investing in private money loans, or commonly referred to as trust deeds. So let's talk about what is loan to value. So loan to value simply is a calculation we use to value or calculate the loan amount to the value of the underlying collateral or the real estate. So let's use a simple example. Let's say we fund a loan of $50,000 and that loan is secured on a property worth $100,000. Well, $50,000 of $100,000 is 50%. So your loan to value ratio in that scenario is 50%, 50% LTV. Now, we use that as a barometer of risk. 50% loan to value is a relatively low risk. And I say that because now at 50% loan to value, if that borrower stops making payments or there's an issue with the loan, you're at 50% loan to value. So the value of that property can drop, or you can accrue that amount of cost before your loan is what we call underwater, or the value of the real estate is greater than what is due to you as the lender. That is the worst case scenario. You don't want to be in that scenario. So let's go back to our 50% loan to value. And we'll talk about the term of, or we use borrower equity. So the borrower equity is the difference between the loan amount and the property value. So we talked about 50% loan to value as the lender's LTV ratio. The borrower has 50% equity in that property. In that scenario, they've got $50,000 worth of equity. I call that 50,000 reasons why the borrower wants to make those payments current. Now, using that same example, let's say you're up at $70,000. You're at 70% loan to value. That's higher risk. The borrower only has $30,000 or 30,000 reasons why to make that payment current. You keep going up 90%, 95%, 99%. When you start going high up in the loan to value ratio, the borrower isn't as incentivized to keep those payments current. And the same is true as you go down. So if you go lower than 50%, 40%, you've got less risk. The borrower has more equity in the deal, more reason to keep that loan current. It's really important that you know that and you follow that, or you decide what your risk tolerance is, where you want to be. I'm going to make it easy for you though. I'm going to talk to you about what my risk tolerance is and why I look at loan to value ratios differently on different properties. So as many of you are aware, I like to fund residential and multifamily properties. I like to also do small balance commercial loans. Residential properties are one of the most transacted types of real estate. And the reason being is that it's in most demand. Everybody needs a home to live in. And there's a huge amount of financing available for buying single family houses. So they're considered, from a risk standpoint and property type, they're the lowest risk you could take in this industry. Let's look at the highest risk type of transaction or property type, and that's going to be land. And the reason being is land rarely ever provides any type of income. It provides very little value to anybody. The only value in land is when you unlock it to, let's say, build a house or a single family home or do something with it. That's why there's value to it today, even though it doesn't have any economic true payout or any value in its current form. Now, I know people are going to say, well, you got, parking lots and whatnot. Yes, that is the case, and sometimes there is income, but rarely is that the case. And that's why it's so risky, because if the market turns, nobody's going to be building homes on that piece of land, so the value is relatively low. It's only when the market is good and people are building that property has value. That's why I stay away from that property type. Now, let's go back to the loan to value ratio. Why is that important? Well, I'm willing to take a higher risk in terms of LTV. Remember that the loan amount to the value of the property on a single family home, because I feel that the value of that single family home will stay fairly consistent because we've got the most demand. Now, right behind single family home on the risk factor is going to be multifamily. And we're talking about right behind, if not equal. People need places to live. The only difference with multifamily is you have investors buying multifamily properties, not homeowners. And so there's just fewer buyers of that property type. Now, in both those cases, I'm okay at 65 to 70% loan to value in the markets that I lend in. I'm here in San Diego. I lend in the San Diego marketplace. I'm pretty confident that they're not going to be bringing enough housing to the market here in San Diego to saturate it, to bring too much housing. So I'm okay even when there's market turmoil to be between 65 and 70% loan to value. I don't think values of real estate, if I lend on a property at 70% loan to value, that the value of that real estate is going to drop by 30%. And I know we had the Great Recession and values came down considerably, but I promise you, if you look at values back in 2010, let's say we were kind of starting to stabilize to what they are today, you're going to see a significant jump in values, and that is what my thesis over the long term believes. Now, let's take a step back and let's talk about like commercial properties. Let's talk about a strip mall, okay? A little strip mall that's got some of the small mom and pop shops. Now, I'm not going to take from a loan to value ratio as much of a risk on that type of property. So I may be between 60%, maybe 65% if the borrower is very strong, property location is strong, and the property itself is in good condition. But typically commercial properties, I'm going to be really capped around 60% loan to value. I believe values of commercial or small, in this case a strip mall, may kind of jump in value more as the demand wanes and comes in and wanes and comes in. So I'm going to pull back my risk, my loan to value ratio on commercial to around 60%. And then you start to talk about industrial and other types of properties like that, where I'm going to be between 55 to 60% loan to value. I feel that there's enough equity for, if the borrower stops paying, that I can get my principal back on my loan and any interest and fees that are due to me. And that is why loan to value ratios are so important, and why it's not just a straight LTV ratio on any property. You have to consider the risk factor of the property that you're borrowing on or you're lending on. Now, next question I always get is, Brock, what about valuation? What are you using to get a value on the properties? Now, I do a lot of fix and flip loans. Fix and flip loans are loans in which the borrower is going to buy the property, rehab it, and sell it. Okay? Now, these transactions happen very quickly. That's the value add I offer my borrower clients, is that we can fund quickly. So in these cases, we're going to do an in-house valuation. I'm pretty confident over the last 15 years I've been doing this that I can really nail down the future value of a property based upon the scope of work and project budget or scope of work and budget that the borrower has. I can nail down, okay, this property should sell based on a price per square foot using other comps. When I say comps, other recent sales in the market. So I'll take these recent sales and I'll bring them all together, formulate kind of a price per square foot, and apply that to my property, that I'll be able to get a value to the property. Now, again, I've been doing this for a long time, so I can do that relatively quickly. If you are doing one-off loans, I highly recommend on a minimum to get a broker price opinion on the property that you're lending against. So what a broker price opinion, also referred to as a BPO, is simply a value that maybe a real estate agent or other professional in the industry will do a quick drive-by. They may actually walk in the property, but just do a quick valuation. Now, this differs from a full appraisal, where appraiser is going to go into the property and they're going to measure the property out. They're going to do a much more in-depth analysis of the location of the property, how it compares with some of the other comps or other sales in the market, and they're going to give you a very detailed analysis. So BPO is just kind of a quick snapshot. Hopefully it's got photos. Hopefully the person valuing the property goes into the property to see its current condition and kind of gives you a relatively good estimate of value. An appraisal is probably the best way to get a value. If you are investing in mortgages, I highly recommend going in the appraisal route, but it's not always an option, and you may want to try a BPO. Either way, look at those valuations very carefully. Make sure that you're comfortable with how they came to their value. So 3 ways of getting the valuation. We talked about in-house valuation. I'll do that for fix and flip loans. If it's a more complicated deal like a small balance commercial property or a large loan size, typically over $1 million, I'll have a third party value the property with a BPO or an appraisal. And then we talked about BPOs, again, quick valuation, and an appraisal, which is a full valuation of the property. Now, I do want to bring up something that kind of makes it a little more complex. I talk about funding second trustees. Okay, I'm not a fan of funding seconds. They're just too much risk. Seconds being that your loan is behind an existing first position loan, and first position loans, as we all know, have priority position. That means that if the property sells, all the proceeds go to pay off the first before you, the second, get any funds. Now, there's this term called combined loan to value. That's called CLTV. And combined loan to value is a calculation when you add up the first, you add up the second, total dollar amount. So let's say you, in our case, in our 100,000 example, let's say there's a $50,000 first and you decide to fund a $10,000 second. The combination of the two is $60,000. You are now $60,000 secured against a $100,000 valued property. You're at 60% combined loan to value, CLTV. And I get so many investors that say, hey, Brock, I'm funding a loan at 60% loan to value and earning some significantly higher return than what market would typically pay out for a loan to value. And I always ask, is it a first or is it a second? And I go, well, it's a second. Say, okay, well, that's why. You are taking a much riskier position. Even you're at 60% loan to value, so you're at a lower loan to value, but you are at a much riskier position because if that first default, if the borrower defaults on the first, you as the second lien holder here have to make that first current, continue to make payments on that first in order for you to protect your principal investment. So loan to value ratios are important. Make sure you're in first position. Make sure you understand the real estate that's securing your loan. You can always ask for the borrower to put more equity if it's a purchase loan or not, if it's a cash out refi or refi. Limit what your loan to value ratio is. Try to target 65% on single family, multifamily. If you start to go to commercial, scale that back down to 60, maybe 55%, and I think you're going to do just fine. So thanks for listening to my explanation on why I consider loan to value ratios an important part of my underwriting criteria. Hopefully you learned something. Hopefully you can apply that to your underwriting, and check out some of the other content that I post. I love talking about this subject. I love talking about investing out of a mortgage fund. So thanks for listening, and talk to you soon. And don't forget to like this video if you thought that the information was important, and either follow or subscribe me on whatever platform you're watching me on today. Thanks. Have a great day.